Good evening. We'll start with this. This is an endowment value, simple increasing endowment value. Okay. So here we'll say our IA 4515 will be equal to IA 45-15 plus I will have 14. Okay, and minus 1 times I will have increase, so into V raised to 15 15p 45. Okay, then IA 45-15 will be IA 45 minus V raised to 15 15p 45 IA 60 plus 15 times A 60. Is our formula. Then V raised to 15 p 45. Let's calculate that first. Now because we are talking about 4%, we can find that in terms of D. It will be D 60 by D 45. Okay. So M92 capital letters, capital D, that is what we are looking for. Capital D 45 and 60. So we will have 882 to 2.85 by 1677.97. So this will be 0.526117. Then we want increasing annuity 4%. Increasing assurance rather, not annuity. Increasing assurance. This is the table 4%. We are looking for ultimate values. So here ultimate value first 45 and then 60. So 45 I have 8.33628 minus answer into bracket, then 60 we'll have 8.36234 plus 15 times A. So we'll go up. Our A60 value will be here. Okay. 0.4564. Bracket close. This is the value. Then endowment value, we'll say term value plus 14 times, because it will be n minus 1 times pure endowment. So finally we'll have 7.7005218. Now we'll talk about chapter 20. Chapter 20 is named gross premium. Now from this point on time, we will be talking about how do we calculate stuff for our actual insurance companies. Okay, so life insurance companies, the main aim of life insurance companies is to sell insurance. Okay, so for that they will have to tell the people how much premium they are supposed to be paid. Okay, premium usually is usually paid in annually in advance. That is the usual route, or we'll say default. Okay, nothing is mentioned, we will be assuming that premium is paid annually in advance, but of course it can be paid half yearly, in advance, or quarterly in advance, or we can have monthly in advance. But premium will always be in advance. The payment cannot be in arrears, because we'll not say that we'll start the policy today, pay us in 1 year's time. We'll never be saying that. So it will always be in advance. Okay. It can be annually, that is what we will be taking at the beginning, but it can be half yearly, quarterly, monthly, whatever. Okay, so usually these are the 4 modes of paying the premium. So premium is the company's income. Okay, for that premium the company is giving some benefits. The benefit is given to the customers or the policy holders. Okay, so we have calculated assurances and premiums, right? Annuities. Premium is usually in terms of annuity, but there can be 2 types of premium. We can have single premium. Okay, single premium paid once at time 0. At the start of the policy, we can have a person paying single premium that would be paid at time 0, or we can have premium annuity. Okay, or you can say premium annuity. Right, we can have an annuity premium, that would be this, right? It can be annually, it can be half yearly, it can be quarterly, it can be monthly. So we can have premium paid either once, that would be called as single premium, or it can be every single year, or every half year, or every quarter, or every monthly. Accordingly, we can have an premium annuity. So now, how do we calculate the premium? That is a big thing. First of all, we have 2 types of premium. We will have net premium, and we will have gross premium. Okay. So net premium and gross premium, what is the main difference? The main difference between net premium and gross premium is that net premium is calculated for the purposes of calculating the least amount of premium that is supposed to be paid. Okay, so net premium is the least amount of premium for a certain policy. Okay, so you can say this is the least premium, and this is the actual premium. Why are we calculating the least premium? One of the reason is there are companies that are making sure that people don't take money in form of premium as a promise for insurance and then run away. Because what is happening is, here you are taking certain amount of money from people and promising them a huge amount in the future. So people should not fraud general public, right? So I can open a company tomorrow, say it is insurance company, and I can sell a lot of policy for very cheap and just take the money and run away, right? That can happen, correct? So that should not happen. So therefore there are many government entities that make sure that these kind of things does not happen. In India, such a government entity is called as IRDA, okay? Insurance Regulation and Development Authority of India, okay? Insurance Regulation and Development Authority of India, that is called as IRDA. So IRDA does their own calculation for a certain type of policy, for a certain amount of sum assured, how much premium should the company charge. So for them, what happens is they don't know the internal workings of the company. They don't know how much would be the cost for them to, you know, produce that kind of policy. How much employees they have, how much is the electricity cost, how much other cost. So they will be calculating the least amount of premium the company would be charging. So they calculate nothing but the net premium. In that, they do not consider any expenses. So no expenses are taken into account. They do not take into account any bonuses. No expenses, no bonuses. So they do not take any expenses, any future bonuses that has not been promised. So see, we talked about with profit contract, in which we said that we can have revisionary bonuses or reversionary bonuses, right? So we can say today that we might give you bonus in the future, and because the company did not make any profit, we might not give you bonus, right? So the chances are that bonuses may not be given. So again, assuming that in future no bonuses would be given, what should be the premium? So while calculating net premium, we do not take into account any expenses. So whenever I say expenses, we have two main categories. We have expenses and commission, right? So for any salesperson to sell a particular product, the company makes commissions, right? So if you sell life insurance, so we have life insurance agent for selling life insurance, right? So if you sell a certain type of life insurance, certain amount of commission would be given to you, right? So that is what the incentive for life insurance agents would be, to sell as many as possible, correct? So there are expenses and there are commissions promised by the company. So commissions can be on first sell of the product and later on as much premium as you collect. So after selling the product, you will be collecting your first premium, but then they want good service to the customers. So they want that the life insurance agents should actually remind people that your premium is about to come up. Please pay the premium. And so that is why what they do is, from each of those premium, they will pay a small commission to those, you know, life insurance agents. So that again, there is an incentive for those sales agents to make sure that they are keeping those policies afloat or keeping those policies alive, right? Because what happens is, if you don't pay the premium in time, your policy lapses, right? Either you will have to pay fine, or maybe you will not get the benefit at the time, okay? When it happens, you might have to restart your policy, you might have to buy another policy. So there are many bad implications of not paying the premium on time, okay? So that is why those and it is also bad for the company as well. First of all, their expected income, that was their expected income. A person who might not die will pay certain amount of premium. That may not happen, right? So they do not want that also. See, whenever we are talking about any financial company, okay, when we talk about any financial company, what every company likes is certainty, okay? So they would want whatever we are expecting to happen the same way. Even though there is a chance that if it does not happen what they were the way they were expecting, they might earn more profit. Okay. But in that case, what happens is it can go the other way around as well. The unexpected things may lead you to losses as well. So for us, for any financial entity, their aim is whatever they are trying to predict, it should happen the same way. So if you have predicted these many people would pay you premium next year, you would want majority of them to pay them, right? So from their side, they would make sure that they the insurance agents should remind them to pay the premium. So for that they have commissions, right? So we have different types of commissions. We'll talk about that later, but we will include them into expenses whenever we are talking about. So in question, they might give you expenses separately, commission separately, but for studying purposes, we are taking expenses and commissions together. So you can write no expenses and commissions. Commissions. Okay. When we talk about gross premium in that we take everything. So yes, expenses and commission. And also yes to bonuses. So whatever bonus we are expecting to give in the future, let's say I'm expecting that from the past, I've seen that every year we give 5% compound bonus. So we are expecting that in future also we will give the same way because we'll be earning the same amount of profit. So I will say, let's take future bonuses as 5% while calculating gross premium. Okay, while calculating gross premium, let's take future bonuses into account. Okay, so we are taking bonuses into account because net premium is the minimum amount that should be taken into account. That is why we don't take any expenses or commission, because company to company the expenses and commission might vary, and we'll not take any bonuses. Okay, because that might be zero in the future, right? When the bonus, company might not make any profit. So even at that point, if a company is charging premium less than this net premium, then IRDA knows something is wrong. Okay. So IRDA knows something is wrong. If a person is charging less than the net premium, then clearly there is something wrong. So there are many fail-safes taken into account by IRDA. First of all, to work in insurance company, if you want to make an insurance company, you have to keep a lot of money as security to IRDA. So they are keeping a lot of money as security because by any chance, if you are not able to pay off your liabilities, the amount that you were saying that you would pay off, if you don't pay off, then the policyholder will go to the IRDA, they will go to the government authority. Please give me my money. This is what they promised me, but they have not given me the money. So then IRDA would take out that money from the deposited amount that they have given. Same thing happens with banks as well. Banks is another entity that deals with a lot of money of people. So for banks, you have RBI, right? Reserve Bank of India. The Reserve Bank makes sure that people don't get cheated. So first thing is they take a lot of money as security before they allow you to open a bank. Same thing IRDA does. They will ask for a certain amount as security before they allow you to sell your product, that is insurance products. Okay. And the second thing that IRDA makes sure is that the premium should be at least this much, more than net premium should be charged. So we'll be calculating net premium, we'll be calculating gross premium whenever possible, right? Now there are many ways we can calculate premium. Okay, the first thing that we will be calculating, first way that we will be calculating is, we'll say no expected loss. Okay. So if I say no expected loss, well, how do we calculate loss? I'll say loss must be my expenses minus income, right? Whatever expenses I had, that must have been more than the income. That gives me nothing but loss. So I can say present value of loss must be nothing but present value of expenses minus present value of income. In this case, what are my expenses? Okay, so my present value of loss will be equal to present value of the benefits that we are providing. I am writing B, benefits and bonuses. Whenever we have bonuses question, we will include that in benefits. Okay, so benefits plus bonuses B. Okay, then we might have expenses, present value of expenses. Okay, so in this expenses, I am including expenses and commissions both. So we can have bonuses, benefits, bonuses, expenses and commission. These are all our expenses. These are all company's expenses. What would be the income? Income is premium. That is the only income that we are talking about. Right? There is only one income, that is premium. Okay, so present value of loss is going to be nothing but present value of benefit plus bonus plus present value of expenses minus present value of premium. Now, of course, we cannot find present value because of the unknown factor. So we will take expected present value. We'll say expected present value of loss must be equal to expected present value of benefit plus expected present value of expenses minus expected present value of premium. Okay. Now, how much loss are you expecting? As a company, you are expecting 0 losses, right? So we would want expected present value of loss to be equal to 0. My expectation of loss must be 0. So if I take expected present value of loss as 0, I will get expected present value of premium must be equal to expected present value of benefit plus bonus plus expected present value of expenses. This is how we will be calculating our premiums. This is how we will be calculating our premiums. We know how to calculate expected present value of premium. Premium is a form of annuity. We know how to calculate benefits and bonuses. We have done that in assurances and also in the bonus that with profit contract chapter. What about expenses? So let's talk about expenses. Expense and commission. Commission. Okay, expense and commission. So we'll say we have 3 types of expenses and commission. Okay, the first type, I'll write it as capital I, would be called as initial. I will just write expenses. You know it is expenses and commission. I'll just write it as expenses. Expense. Okay, initial expense. Initial expense is whatever expense that we will incur at the beginning of the policy. Right. I have to, let's say, print a lot of flyers. I have to pay for advertisement. I have to make sure that the people who designed those products, that is, let's say, actuaries and salesperson and accounting person, their salaries are paid. All of these, a lot of expense comes at the beginning. That is called as our initial expense. before even we start our product or sell our policy, there will be a lot of expenses that comes into initial expense. Then we'll write E. E is called as a renewal expense. Or even annual expense. Okay, depending on whether we are talking about, let's not write it as annual expense, because we might have it as monthly or quarterly or half yearly or whatever. So we call it as recurring expense. Okay, so every time, usually every time when you are renewing your policy, that means whenever you are paying the premium, second premium, third premium, fourth premium, at that time the company might have to take some expenses account. All right, the salaries that they are regularly paying to their sales people, then the customer care people, management people, a lot of money they will have to make sure that it comes from somewhere, right? So that is their expense. So it can be called as renewal expense or recurring expense. We'll write that as E. Then F, we will write that as terminal expense. Terminal expense, whenever the policy terminates, like when we are talking about endowment policy, at endowment policy, when that policy ends, whoever survives, we are going to give them money, right? So at that point, when the policy ends, we might have to pay a certain amount. In that, again, there will be some paperwork. We will have to maybe make checks. There will be accounting department. There will be sales department. So many departments that will be involved, their salary and everything. So we'll say there will be some expenses on termination as well. And even on death, right? A policy terminates on death as well. So if a person dies and we have to pay out money, there will be certain investigations. We need to make sure that it was not a fraudulent case, right? It's a real death certificate. We'll have to make sure of that. We will have to make sure that it goes through the correct channels. It reaches the correct places where checking can be done. There are investigation agents. They just go around and make sure that everything was correct in the report and everything. Okay. Then it goes to people who will make sure that where the money comes from, whatever, right? There will be a lot of expenses involved even when there is payment involved, whether on death or whether on maturity. So a policy terminates in two ways, either on death or on maturity. In both cases, we might have some expenses. Those expenses will be called as terminal expense. Okay. So we have three types of expenses and commissions. We have initial, we have renewal, and we have terminal. I have never seen a terminal commission. Okay. Usually commissions are of two types, initial and renewal. But let's say if in future, whenever it comes, if there is a question where we see in terminal commission, then okay, good enough. The calculations are basically same. The calculations of expenses and commission are exactly same, and that is why I don't make two different what do we say, expected present values or anything. You can say expected present value. We will take only one for expenses as well as commission. So first, let's talk about present value of expenses. Present value of expenses, initially, the initial expense. So see, if I make a timeline, let's say a person age X goes for age X, takes a policy, okay, and this is how our policy goes, and at X plus N, the policy terminates. So what we'll say, we had an initial expense here. After that, we had renewal expenses here, 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 and so on. And we will have a final terminal expense here. Okay. So what we say is present value of initial expense is always going to be I. Everybody pays it when the policy is bought times 0, initial expense. Then for renewal expense, you can write it in two ways. Okay. You can write it as E, okay, and an annuity in arrears for n-1 years, because if the policy is going for n years, then the renewal expense will stop at n-1. So I can say E arrears n-1 years, or there is a better way of doing this. Okay, I will show you, and that is always what we will be using. Okay, I'll say initial plus E, we'll write it as A due n-1. Okay, so we are saying this policy, this whatever renewal expense is going for n years. Okay, renewal expense is going for n years in advance, except for the first year. Except for the first year. So we have removed the first year from it. Okay. So initial expense, renewal expense, then terminal expense. Terminal expense will just be F at time of termination of this policy. So V raised to N. Okay. These are the three types of expenses and commissions that we will be seeing. Now, how does it translate to the expected present value? So if I am talking about whole life policy, I'm talking about whole life policy, then it will just be expected present value of expenses. Initial will just be I. No problem. We are multiplying with probability. Everybody is going to pay that initial expense. Then recurring expense depends on whether the person survives that many years, right? So it's becoming annuity. We'll write it as E A due x minus 1. This is what I am saying. You can definitely write it in terms of arrears, A due x, but A due x is nothing, AX is nothing but A due x minus 1. I prefer writing in this form. This is just consistent in every case. Okay. Plus the terminal expense will be AX. Right? You can see here V raised to, okay, so AX. For term and endowment, expected present value expenses will be initial as it is, but here the policy is not going for whole life. The policy is now going for only n years. In both cases, term and endowment, the policy is going for only n years. So it will be E A due xn minus 1. Okay. And according to term or according to endowment, we will have a different this. So I'll say plus F A x dash n for term, and for endowment only that will change. I will just write F A x n for endowment. Any problem here? So let's take a question. Let's solve 20.5. Okay, we'll solve 20.5. So when insurer issues a combined term assurance and annuity contract to a life age 35. So this is going to be a very complicated question because we will have term assurance as well as an annuity contract. I just want to show you how our expenses would work because we have initial, regular as well as claim expenses. Okay, so here we will go slowly one by one, understanding what's going on. Okay, level premium are payable monthly in advance for a maximum of 30 years. Okay, so we have a term assurance as well as an annuity contract. The premium are payable monthly in advance for maximum of 30 years. On death before 65, a benefit is paid immediately. Okay, so the benefit is 200,000 on death in the first year of the contract, 195,000 on death in the second year. So we have a decreasing benefit. So see, this is not bonus, this is decreasing benefit. Okay, and so on. The benefit decreases by 5,000 each year until age 65. No benefit is payable on death after age 65. Okay. On attaining age 65, the life receives a whole life annuity of 10,000 per annum payable monthly in arrears. Calculate the monthly premium using the following basis. So here you can see we have two different tables to take into account as well. I'll go slowly. Okay, so rather than solving the whole question first, I just want to show you how the expected present value of expenses will work. Okay, so today right now I just want to show you how the expected present value of expenses would work here. Okay, so we'll not solve everything, we are just going to solve expected present value of expenses. Expected present value of expenses, initial is 350. So initial will be as it is, 350. Then we have regular assumed incurred annually at the start of each year during the deferred period equal to 45 in the first year, inflating at the rate of 4% per annum. Okay, so you can see assumed incurred annually at the start of each year. Now here they can mention that our recurring expenses can start from the second year, or they can mention that it is starting from the first year itself. So you can see it is assumed incurred annually at the start of each year during the deferred period, that is the first 65 years, from age 30 to age 65, right? 30 was the initial age, yes. Age 35 to age 65 is when, that is the deferred period that they are talking about. That is where the regular or the recurring expenses might happen. But they did not say that it is going to start from the second year, right? They did not say that it will start from the second year. So here our expenses will not be -1. Here our expenses even for this will not be -1 because it is not starting from the second year, it's starting from the first year. But we have something else. We have an inflation rate of 4%. Okay, so that just means in the first year, the expense, renewal expense was 45. In the second year it was 45 into 1.04. In the third year it was 45 into 1.04 whole square. In the fourth year it is 45 into 1.04 raised to 3 and so on. We'll be discounting. Here I am going to put V, here I am going to put V square, here I am going to put VQ. I can make it into V dash. I can make it into V dash. If I write it in terms of V dash, what do I get? I'll take 1.04 V is equals to V dash. What is our rate of interest? Here our rate of interest, what is our rate of interest? Where did they mention the rate of interest? Interest rate is 4%. Here they have mentioned it, right? Interest rate is 4%. So what do we get here? We'll get 1.04 by 1.04 is our V dash. V dash is equal to 1. That means our I dash must be equal to 0. Because we'll get I dash as I minus B upon 1 plus B. I and B are same. I and B are same. So we have 0%. Now remember, yesterday we made equations of 0%, right? So here we will be getting 45 ADU. We have select mortality, so select 35 going for 30 years. We don't have -1 because it is starting from the first year, but we have at the rate of 0%. We have at the rate of 0%. We'll talk about how we would calculate this. Okay, just give me 1 minute, okay? I'll be back. Okay. So is this clear? Renewal expense. And then claim expense. Claim expense, because we are again going from only, see, this claim expense for each of the annuity payments. Okay, so this claim expense does not count in terms of assurance payments. They are talking about the annuity payments. Annuity payment is going to start after 65. Okay, so this claim expense will start after 65 only. Okay. So annuity is going to start after 65, 10,000 per annum payable monthly in arrears. So only if the person survives for 65 years, this annuity will start. So it's a V raised to 30 years, 30p, select 65. Only if the person survives for these many years, then the annuity payment starts. That is 0.5% of each of the annuity payment. 0.5%, that means 500. 500 payable monthly in arrears. Okay, so after age 65, starting from 35 going 30 more years, after age 65 the payment of 500, that is our expense of 500, starts payable 12 times for a person who is age 65, right? This is how we will write our expenses. Okay, so these two are very common expenses, initial and renewal. This is not so common. Okay, so we will see other questions where we will find expenses and then try to solve them. Okay, let me just see any other question we have with expenses. Question number 20.2. Okay, question number 20.2. Yeah, they are saying show how you would modify the premium equation below to allow for the expenses indicated. So this is our premium. Say see, we say expected present value of premium must be equal to expected present value of benefit plus expected present value of expenses. How much benefit are we, first how much premium are we paying? We are the policy holder is paying the premium P. For how many years? In this it seems like for n years only, so A due X N. Okay, so annuity payment for n years, so this is an annual premium. Then benefit is sum assured. How much sum assured is given? S is given. For anybody this seems like an endowment policy, endowment X N. Right. So this is how our premium, net premium would be for endowment policy. But of course we are now allowing for expenses. They are saying initial expense of 2% of the sum assured. So we'll add the initial expense 2%, so 0.02 S. This is our initial expense. And they're saying renewal expense of 2% of each premium including the first. See here they are even using the word including the first. Okay, so again we will be using including the first, so we don't have to subtract, plus 0.02 S A due going for only n years from age X. Okay. Then claim expense of 2% of the sum assured. Claim expense, we are expecting claim to happen on death as well as on maturity. So everything. Okay. So therefore plus 0.02, it will be whenever assurance was paid, we are paying claim expense as well. Then initial expense of 50% of the first premium plus renewal expense of 3% of each premium excluding the first. So initial expense as well, here we'll just say 50% of the premium, 0.5 P. Usually this is how the commissions are given. Okay, the commissions are written as the percentage of the premium. Okay, so usually these type of commissions are given. So they are saying 50% of the first premium plus renewal expense of 3% of each premium excluding the first. So here you can see excluding the first, 3% of each premium, A due X N minus 1. Now how would we combine it? I'll say premium A due XN. I can take all the A due XNs this side, but I will do it later on. I'll say sum assured plus 2% of sum assured. I can add these two. So I'll say this plus 2%. I will have 1.02 S AX N. And these two together, but also I will subtract 0.03 premium. Okay, 0.03 premium, if I subtract from 50%, would be 47%. So I'll say plus 0.02s plus 0.47 p. 3% have been removed. Then I am left with these two. I can combine these two. Plus 0.02s plus 0.03p into a du x n. Now I can take this here. So finally I will get p minus 0.03p, 0.97p plus 0.02s a du x n must be equal to 1.02s ax n plus 0.02s plus 0.47p. This is how we will rearrange our equation. Okay, a small mistake. It should be minus. Okay. Let's solve a few questions from here. Now, do you understand how the expenses are taken into account? Let's take this question, page number 21 question. Okay. Page 21 question. A man aged 45 buys a 15-year with profit endowment assurance with basic sum assured of 25,000. So we have with profit. Determine the single premium to be paid for this assurance. Single premium, that means we are talking about single premium at time 0. So expected present value of premium, will just be that premium P. So expected present value of premium will just be P, single premium. To be paid for this assurance, assuming that the simple revisionary bonus of 6% per annum vested at the end of each policy year, and that the death benefit are payable at the end of the year of death. Assume 95% ultimate mortality and 4% per annum interest. The initial expenses are 200 and renewal expenses are 30 at the start of each policy year, excluding the first. Okay. So even though here we have percentage, you can see we have bonus as 6% per annum. But what did they say? They said simple revisionary bonus. So each year the bonus is 6% of 25,000. Okay, so don't get confused. Even though percentage is written, it is not compound bonus. Okay. So we'll calculate the expected present value of benefit plus bonus. Whenever I'm writing B, we are talking about benefit plus bonus. So the benefit is of 25,000 and each year we are saying 6% of bonus will be added at the end of each year. Okay. At the beginning, I always make the timeline so that we don't get confused. Okay. So x plus 1, x plus 2, and so on. This would be x plus 14, x plus 15, and then survival benefit. So we are saying if the person dies within the first year, then 25,000 would be given. I will just write it as S because first years of bonus is not given here, right? It is vested at the end of each year. So we know the bonus would be given next year. Next year, if the person dies within the second year, we will have S plus B. For the third year, S plus 2B, and so on. We'll have S plus 13B here, S plus 14B here, but survival benefit will always be the complete number of bonuses, that is 15B. Okay. So our expected present value of benefit, how would we write it? Always death benefit plus survival benefit. So this will be first is S and increase is B. So I'll have S minus B, A, what was the age? 45, right? Ultimate mortality, so I have A 45 dash 15 plus B IA 45 dash 15. Okay. This is a death benefit. What about survival benefit? Survival benefit of this much. So plus S plus 15B. Given when? Given at time 15 if the person survives from age 45. Okay. So we'll calculate these later on. Let's make the equations for some expenses as well. You can see this is our benefit. They are saying assume AM92 ultimate mortality 4%. Initial expense are 200 and renewal expense are 30 at the start of each policy year, excluding the first. Now, because our policy is only going for 15 years, the renewal expense will also go for 15 years only. If the policy has ended, we will not be paying any premium, we will not be claiming any whatever claims and whatever. So the policy has ended, so there should not be any expenses as well. So expected present value of expenses initial is 200. Okay. And left 30 at the start of each policy year excluding the first. So A due, we've age 45 going for 15 years minus 1. Any problem here? Now this we can calculate. A 45 dash 15 would be A 45 15 because this becomes 60 and we have the endowment values minus V raised to 15 15P 45. This will be used also in the increasing one. So increasing IA 45-15 will be IA 45 minus V raised to 15, 15P 45 IA 60 plus 15 times A60. I think this is exactly what I asked you to calculate at the beginning, right? This is what we calculated. And for this we will require V raised to 15, 15P 45. Again, you can use it a traditional way, or you can calculate this from D, because our because our rate of interest is 4%. So I prefer using D. It's just a little bit less calculation. You don't need to even write in terms of D, or if you want, you can write only in terms of D as well. You can skip writing everything in terms of these as well. Okay, everywhere wherever we have V raised to n npx, you can write in terms of D, no problem. Okay, so D 4560, everything is ultimate. Then we'll use this to find our term assurance value as well as the increasing term assurance value. Okay, so first let's go to our term assurance. Term assurance I will be calculating from the endowment value. Again, it's slightly easier than calculating from the whole life value. 4%. I have now here the endowment value. I want ultimate 60 45 15 0.56206 minus answer. I write as much decimal points as I want, but we will be using only 6. We will not be using all. Okay, so I can round it off. So I can round it off to 3 here. Then for increasing term, what I'll do is I will again use this equation and press equal to. So now again this is my answer. This is my answer now for even the next one, so that I don't have to type. So increasing ultimate 4560, okay. 45 and 60. So 45 8.33628 minus answer into bracket 60 would be 0.32634 plus 15 times capital A 60, capital A 60 0.4564 bracket close. Okay, this value we can directly take from the endowment table. Okay, so we'll do that later on. First let's find this. So S was 25% and B was 6% of the 25%. Okay, so I can just say it is 0.94 into 25 this is our initial value. Okay, or I will just take everything in terms of 25. I'll say 25,000, then bracket. Okay, or let me just calculate. I just don't want you to get confused, so I will just calculate 25,000 into 1 minus 0.06. that is the first value, that would be 23500 A45-15, and plus 0.066% of 25,000 is 1500, so 1500 by A45-15 plus 25,000 plus 15 times 1500 is 47500. 475, this is 1500. 47500 v raised to 15, 15p 45. We've calculated all these three values. Let's wait. 23500 into 0.0359183 plus 1500 into increasing, what is the increasing value, 0.334538 plus 47500 into 0.5261417. This becomes our expected present value of benefit. I will write it down here because I always leave one line for our answer, but anyways I have now filled it. It's equals to 26337.618. Our expected present value of benefit. What about expected present value of expenses? We have 200 plus 30 into ADU 4515. We'll go to the endowment table. In the endowment table, we have this temporary annuity as well. So ADU 4515 is 11.386. I'm subtracting one, so I will directly write it as 10.386. 10.386. These are expenses. So therefore our premium will be addition of these two. Now these answers should be at least 4-digit accurate. So you can say this answer, the final answer could be 26840, or it could be 850. Anywhere between these two will be accepted, or maybe a little bit more than 5. If you round it off, it should give you either this or this. Okay, so both will be accepted. Let's see what is the answer in the book. Yes, you can see 26849. Okay. See, they also use D60 by D45 just because it is easier for calculation purposes. Okay. Don't get confused. Many times what they see, this is the exact equation that we made, right? Instead of writing pure endowment, we wrote V raised to n NPX. Now sometimes they write it in this manner also. So you can see here 23,500, they are using endowment value. That is term plus pure endowment. Where does this pure endowment value comes from? It comes from here. Now you can see the pure endowment value has gone down to 24,000. If you add 24,000 and 23,500, you will get this 47,500. So don't get confused. If your equation is not matching, first look whether they have done using endowment or whether they have done using term. So both of these equations are exactly same, but instead of taking only term here, they have made it into endowment. The extra value came from here. That is why instead of 47,500, it has gone down to 24,000. Now tell me, any problem? This was our single premium. Any problem here? Now from this point on till chapter 28, conceptually understanding what's going on is very easy. We don't have any complicated concepts. It's very straightforward. When I tell you something, you will say like, of course it has to be like this. What other way it will be, right? We always take the expenses, we always take the income, find their present values, find expectation of that happening, and then figure the expected value of premium or whatever we are trying to figure out. So it's very straightforward. Okay. The only problem comes in the calculation part, making the equation, then calculating it correctly. Okay, making the equation is the hard part. Calculating is the easy part, but then what happens is we make a lot of mistakes in calculation. Okay. Making, ultimate or select mortality, we make a lot of mistakes. 4%, 6%, we make a lot of mistakes. Sometimes just 60 or 61, we make mistakes. Okay. Now, if we are making calculation mistakes in the examination, that is very unfortunate. Okay. If you are making conceptual mistakes, that means you have not studied enough, right? If you are making calculation mistakes, that means you have not practiced enough. CM1 requires a lot of practice. Okay. So sometimes what happens is we are conceptually perfect, but still we don't get enough marks. Why? Because we did not practice enough to make sure that we can complete our paper perfectly in 3 hours. Okay. In this paper, accuracy really matters because we will have very lengthy questions. We'll have 25 marks questions and stuff, 20 marks, 25 marks questions. In that, if you make a mistake at the beginning, everything else goes wrong. And it's a basic rule, wherever you make mistake, everything after that is considered wrong. So you don't get marks for anything that you might have done correctly later on, or maybe written the correct equations. You will not get marks for that. It's just a basic concept of correcting papers, that wherever you made a mistake, after that everything else is wrong. Okay. So accuracy here matters a lot. So let's not make any calculation mistake. Let's practice as much as we can. Okay. So I have talked about this before. Book questions, then assignment, and then X series. Okay. X series, that is behind the book. This is how you should be practicing, and all of this should be done at least 3 times. Okay. At least once should be on Word as well, right? Now I'm hoping that you have mastered how to type in Word. Now if I say type v raised to n npx in Word, now you know how to type it. Maybe npx you are confused a little bit. Okay, I think I'll just show you. See, even I was making what do we say, the sheets yesterday that I told you that you should make the formula sheet. I thought I should also make it because I have never made these myself. Of course I had made it on paper when I was studying, but never made it on Word because never needed it. My paper was on paper, right? So anyways, what I do is I make this, and as soon as I start writing the formulas, it starts going down, and whenever I need, I copy it and paste it. I have shown that in the annuity videos, right? I'm hoping that you are all following those. Okay, so this is my formula sheet. I have written for each one of them present value, expected present value, and variances, and how to find each of these values. So see, this I can find from table, this I have formula, this I have formula, then again whatever annuity, all the different kinds of formulas that I can see for finding different things. I've written that. I might make it a little bit better to at least see, because here it feels like it is not very well organized, right? I'll be doing that later. So in this, if I want to make a formula, okay, so v raised to n npx, if I want to write v raised to n npx, what we'll be doing is we'll say v raised to n space, okay, and for npx I showed you one way. We'll put bracket raised to blank and then underscore n bracket close p underscore x. This is one way of making npx. There is another way of making npx. Okay, so what you can do is, as we write v raised to n space, okay, after that you can put a space underscore n, another space p underscore x, and now when you put space you will get that same npx. Okay, just happens that this does not have italic in it. Okay. So there are two ways. I'll just write it without. Okay, I will write it without this. Before I showed you this way, right? P underscore x. This is how we used to write npx. Of course, you can still use this. The other way is space underscore n space p underscore x space. This is also going to give you those values. Now if you are worried about these red marks and blue marks, don't worry. I will show you one single way you can remove it while you are typing. Go to your file. In file, go to options. In options, you will have proofing. There will be a lot of options. We'll go to proofing. In that, you will have to go at the bottom. The bottom, hide spelling errors in this document only. Hide grammar errors in this document only. Press OK. You can see blue mark and red mark have gone away. It's not going to show you any grammar mistake or any spelling mistake, because of course these are not mistakes. If you're worried about this blank box being shown, don't worry. Don't worry about the blank box. You can also put a space there and that blank box goes away. But it does not matter. You can leave the blank box as it is. Okay, don't worry about it. Similarly, if in prefix you wanted something on top, let's say 2ax, if you're writing 2ax, okay. Okay, so if I am writing 2ax, what I showed you was bracket raised to 2 underscore bracket close. So sort of we had to write both of them. One was blank, one was written, and then a underscore x. Right? This is how we write 2ax. Right? Again, you can leave the blank box as it is, no problem. The other way is you can put space raised to 2 space capital A underscore x space, and you can see it's the same. Just typing a little bit less, but you will need a practice for this, especially this first space is where we make a little bit of mistake. Okay, so I'll just write down again what we were doing here. I was doing bracket raised to 2 underscore as it is bracket close a underscore x, and then space gave me the correct answer. And the other is space raised to 2 space a underscore x. Okay, both will give you the same thing. So of course I am making all of these so that it looks, proper. That is why I have used the annuity symbol here. You don't need to. You can always use those brackets less than and greater than signs, okay, for annuity symbols. But if you're using, just make it and just copy paste wherever required. Okay, that you can do the same thing in your examination also. Just make this at the beginning and then properly copy paste whenever required. Okay. So again, as I said, it's not necessary. I just want it to look proper as we would expect in the book. That is why I have written it that way with that annuity symbol. Okay, so maybe you can start practicing in Word directly. I don't know whether it will be fast, whether it will be possible, whether it will be not, but at least you can start with a few sums. Okay, maybe book sums, when you're solving, first write the equation on paper and then immediately type it on Word, so that your speed starts increasing. Okay, so maybe you can start doing two things together. If you feel like you're going very slow, then first do it on paper, make sure all the concepts are solved, make sure all the questions are solved, and then go for the Word. And then in Word, maybe solve only the difficult questions. That can also be done. Okay, so that would be a second practice. Okay, so first solve all the book questions, assignment questions on paper. Make sure your concepts are very well done. Make sure you're not making any mistakes. Then solve only the difficult questions on Word, so that you make sure you've practiced properly. Okay. Let's solve another question. In this, we will have premium payable some number of times. Okay, so this is page number 22. Page 22 question. Sam, aged 40, buys a 20-year term assurance with a sum assured of 150,000 payable immediately on death. Calculate the quarterly premium payable by Sam for this policy. Assume that initial expense are 60% of the total annual premium plus 110 of and the renewal expenses are 30 per annum from year 2 onwards. Now before we solve this, renewal expenses, okay, whenever premium is payable m number of times, or you can say renewal expenses payable m number of times. See here, what they are saying is renewal expenses are 30 per annum from year 2 onwards. First of all, we are skipping our year 1. Okay, assume that the initial expenses are 60% of the total annual premium plus 110. Renewal expenses are 30% per annum from second year. Now this renewal expenses, they have not related it to the premium. Even the premium is paid quarterly. Our renewal expense is paid annually in advance. Okay, let me just confirm that. Where are the expenses calculated? Premium benefit expenses. Yes, you can see here they have not taken payable whatever times. So renewal expense is annually, because they did not write it how many times are we supposed to be paying, or they did not write it that renewal expenses will be every time when the premium is paid. Okay, so they said renewal expenses are 30% per annum from year 2 onwards. So in this case, how would we write? First, I always write expected present value of benefits, expected present value of premium, expected present value of expenses. So expected present value of premium, because the premium is paid quarterly and we need to calculate the quarterly premium. See, calculate the quarterly premium. So I'll say 4P would be paid annually, P being the quarterly premium. And then A due 20 years, 40 years to 20 years, select mortality. So I will put select on age, and annuity angle here, payable 4 times a year. This becomes our expected present value of premium. What about expected present value of benefit? Benefit is 150,000 payable immediately on death. No bonuses, nothing. Term assurance. So 150,000 payable immediately on death. So A bar. Select 40. It is term. So dash. And then 20. Payable immediately on death. Then expected present value of expenses. Expenses, they said 60% of the total annual premium. Annual premium is 4P. 4P, 60% of that. So I will have 0.6 into 4P, right? So that is basically 2.4P. 2.4P plus 110 plus 110. That is our initial expense. Initial expense plus renewal expense is 30 from year 2. So it's a 30. A due select 40 going for 20 years minus 1. These are all 40, 20, 40 20. So 60 value is given to us. Let's first write a bar, select 40 dash 20. Because it is payable immediately, I will get 1 plus I raised to half. What was the rate of interest? Rate of interest was 4%. Okay. And for A, I will have A, select 40 20 minus 4%, so I can directly write it in terms of D. I'll say D 60 by D select 40. D select 40. And directly write the formula in terms of D. Instead of writing V raised to n NPX, I can directly write it in terms of D. Then A due, select 40, payable 4 times 20. For this, you can make it in terms of whole life annuity, but we can also make it in terms of temporary annuity. Remember? Okay, I don't think I have written payable m times formula, but just remind you, this can be written as A due, select 40 20 minus m minus 1 by 2m, that would be 4. So 4 minus 1 is 3, 3 by 8. 1 minus V raised to n NPX, I will again write it in terms of D, D60 by D select 40. V raised to n NPX written as D. So of course we will have to calculate D60 by D select 40. We'll be using that 2 times. So let's do that. Now one of the reason I prefer writing D is, of course, it's easier to type. Okay, instead of V raised to n NPX, D is easier to type. Secondly, because in my brain I know that D is only used for 4%, right? So whenever I am writing D, subconsciously I know that I am not making any mistake in terms of rate of interest. I know D is only used for 4%. So whenever I am using D, I am only using 4%. D select D60 882.85 by D select 40. Select 40 would be this 2052.54. Okay, I'll use this. It's 1.04 raised to 0.5 into bracket. We'll go to the endowment table for 4%. So endowment table, we want select 40 20. Select 40 20. Endowment value is 0.46423 minus answer. Close. Then this value, A due, this much, whatever. So A due 40 20 we can directly take from the endowment table. Here again I will take this as answer again. Then A due again 40 20 is given to us here. It is 13.93. minus 3 by 8 into 1 minus answer. Get close. Okay. So we have 13.716297, or this is 7163. Okay. So accordingly, what will be our expected present value of premium? This much into 4 to 4 gives me 54.865 P. 54.865 P. Then this much into benefit, 0.0347798 into benefit was 150000. So expected present value of benefit becomes 5216.97. And then expenses we don't know in terms of P, that will be as it is, 2.4 P plus rest of, we know, 110 plus 30 into, we got that as 13.93, right? This ADU select 4020 was 13.93, so 12.93, because we have minus 1, so we have 497.9. Okay, these are the values. Expected present value of premium must be equal to expected present value of benefit plus expected present value of expenses. So I will take all the premium parts together, this much minus this much. So I have 54.8652 minus 2.4 P will be equal to addition of this plus this, 5216.79 plus 497.9. So our P, that is our quarterly premium, quarterly premium comes out to be 108.923. So quarterly premium. These are all gross premiums because we are taking expenses into account. Right? We have expenses into account, we have bonuses into our account. So these are all gross premium. In book, most of the questions you will find would be of gross premium. But in the assignments, you have gross as well as net premium questions. Okay. Many times they don't even give you expenses. Sometimes they do give you expenses, but they ask you to calculate net premium. Okay.
Sir?
Yes.
In Word, in term and pure, how do we get the dash on top of the X or the N?
Okay. So first of all, while writing the answer, first I'll just show you what I do for that dash, but in the examination we don't need it. Okay, so what I do is, okay, if I want a and then underscore x, and then I need x and n. For n I will be putting this, just copy this and go up, paste n, okay, bracket close, and then raise to 1. Okay, and you can see it is above x. If I want to write it as an what do we say, pure endowment, I will just put space and make it above n, right? But in the examination, don't do that. In the examination, for writing term assurance, just write TA. Okay, so here we'll say TA under root of bracket x. Let's say we are talking about 4520. Okay, so if we are, let's just select 45, I'll just select 45, and then for 20, I have already copied the annuity. I'll say paste, and then I'll say 20, bracket close. This is our term assurance, TA. And for pure endowment, you can write PE. Plus, if I want pure endowment, I'll write PE underscore, again bracket, select 45, and paste, and we'll say let's say 20, bracket close. This is equal to our endowment assurance, so is equals to A. For endowment you can just write E as well, but A works too, no problem. A underscore bracket select 45, bracket close, paste 20. So you can see here, right? You can write like this. So term assurance, write TA. Pure endowment, write PE.
Sir, the first way in which you had written, would that be correct?
I could not hear you. First page.
Sir, the first way you wrote with A, term assurance,
Yes, it is
is that
correct.
correct
Yes,
as
yes,
well?
yes. It is correct, but it will take more time. That's my point. Okay, so these are the notations given by the institute, so we can use it directly. TA, PE, we can use it directly, no problem. Okay, so yes, you can use it like this. It just takes a little bit more time, and there is a scope of mistake, especially if you are writing pure endowment like this. There is a scope of mistake that you forgot to put spaces. That is my only point. Otherwise, yes, you can definitely write it like this. So practicing, you can definitely practice like this at the beginning. So as I said, you should make a formula sheet on paper first. First make it on paper, make sure that everything is written. Later on, you can make it on Word. So when you're writing it as a formula sheet, you can write these things. It's just visually better. But when you're solving answers, write TA. Make sure that while writing this, now you understand how much more time it might take. So while you're writing TA, you will while solving questions, you will be remembering that we should write TA. We almost never write pure endowment, right? We write it as V raised to n NPX. Okay, so you don't have to worry about it. Okay, so 108 is 108.93. That is what we are getting. Let's see this question. Okay, this question I think we just did or did not. Anyways, this is single premium. What is complicated in this question? Expenses. Let me just see the expenses. It's just compound increase in the expenses, nothing more complicated. Nothing more complicated. I think you will be able to solve this. Let's see this question. This question. Okay, now see, there are this principle that we used. This principle is called as equivalence principle. Okay, this is called as equivalence principle. Now there are many other methods without using equivalence principles as well. Okay, so far we have seen two ways of calculating gross premium to satisfy a probability. Okay, I'll talk about that later on because that is more difficult to understand, so I always do it later. Okay, and using the equivalence principle, we just did the equivalence principle. Okay, equivalence rather, not equivalence, it is equivalence principle. So we never use those words, so that is why, no problem. Okay, so here what we did was, here we said expected present value of the future losses must be equal to 0, right? That is what we did. So that on average, provided the assumption used are true, the contracts will break even. It is usual to load premiums for profit so that the expected present value of future losses is less than 0. So if you want to make profit, you can put expected present value of profit is greater than 0, or you can say the expected present value of loss is less than 0. Yeah. So you can add a little bit of profit. That is called as loading for profit. So if a criteria based on this expected value is chosen to reflect the loading for profit required, then the gross premium including a profit loading can be determined. Okay, so what we are doing is we are loading for profit. We are taking a small amount that is meant for profit. Okay, so now these kind of equations are supposed to be made with probabilities, so with present values. Okay, so you can see calculate the annual premium payable monthly in advance for a deferred annuity. Okay, so we have deferred annuity of 12,400 per annum to be paid quarterly in advance for age from age 60 to a male now aged 40. So after 60 the annuity starts for whole life. Okay, initial expense are 80% of the whatever. Okay, so expenses and everything. Okay, they're saying and the expected present value of profit is 2% of the annual premium. Okay, now expected present value of profit is 2% of the annual premium. Assume AM92 ultimate mortality and 4% per annum interest. So because they have given us expected present value, we can say our expected present value of profit, like we made for loss, expected present value of profit must be, we are making profit from premiums, that is our income. So expected present value of premium minus expected present value of benefit minus expected present value of expenses. This is how we will make our profit. Correct? So this is the equation that we'll make. Any problem here? So this is profit loading or loading for profit. We are saying expected present value of profit is 2% of the annual premium. Okay. So we are saying premium is payable monthly in advance. Monthly in advance, right? So therefore 4P will be the annual premium. sorry, monthly, so 12p, because it is monthly. So 12p will be the annual premium if we take p as monthly premium. Okay. Anyways, now here they are asking us to calculate the annual premium. So I will say annual premium. This is which page question? Let me just, this is page 25. Page 25 question. Okay. So annual premium, I will write it as 12p. I will find p as monthly premium and then final answer must be 12p. So therefore our expected present value of profit is actually 2%. So 0.02 into 12p. This is what our profit is. Okay. So now we can use this. We can find expected present value of premium. So they are saying premium payable monthly in advance. So 12p a due. Okay. Now here what is happening is premium is paid in monthly in advance for a deferred annuity for this much to be paid quarterly in advance, this much the initial expense, renewal expense incurred to the start of each year from the second year onwards, annuity payment expense are this much, and so I think here the premium is paid till life. Let me just compare, because they did not say for how many years the premium should be paid, right? So premium is going to be paid till life. They have taken only 20 years of premium payment. Now usually what happens is, this happens while they are making small questions, they make small mistakes. Here they should have said the annual premium payable monthly in advance, okay, for a deferred annuity payable quarterly in advance, whatever. So they should have said that premium paid till the deferred time period. Either they should have used the word deferred time period, that is for the first 20 years when there is no annuity. Okay, so because we have deferred annuity, what is happening here is we are saying for age 40 to age 60 there is premium payable. Okay, and then benefit starts. Benefit as an annuity. Okay, so benefit is as an annuity. Okay, I made a simple logical mistake. Whenever benefit is as an annuity, you will not be charging premium at that time, because basically what is happening here is, if I say premium is payable at this time as well, you will say you are giving me 12,400, subtract the premium from that and give me only the rest of the value, right? So the premium is not payable when we have annuity as our benefit. Okay, so premium will be paid only for 20 years. So they should write annual premium pay monthly premium payable monthly in advance for the deferred time period, or they should write for 20 years. Okay, so anyways, a due 40 20. This is what our expected present value of premium is going to be. Benefit is starting from age 60. So my expected present value of benefit will be 12,400 here payable monthly, right? The annuity 12,400 is payable quarterly in advance from age 60, but the person started at age 40, so must survive at least till age 60. So we'll say V raised to 20, 20p40, the person should survive for 20 years, and then the annuity starts. 12,400 per annum, paid quarterly in advance. So A due payable 4 times from age 60 to life. There's no limit for that. So this becomes our benefit. Expected present value of expenses. Expenses. We have initial expense are 80% of the annual premium. 0.8 into 12p. Renewal expense are 4% of the annual premium. 0.04 into 12p incurred at the start of each year from year 2 onwards. At the start of each year, so payable 1 times, okay, 40, 20 minus 1. Then we have an annuity payment expense are 15 per payment and the expected present value. Okay, so annuity payment expense would be paid whenever annuity is paid. So exactly the same way. So I'll say plus 15 V raised to 20, 20p40, A due 60, payable 4 times. They are saying 15 per payment. In year we have 4 payments. So it should be 15 into 4, that is 60. It should be 60. Okay. 15 per payment, and in 1 year we have 4 payments. Therefore, annuity claim expense becomes 60. So these are our expenses. So this A due 60 payable 4 times would be A due 60 minus 3 by 8. Right. Then A due 40/20, that is 60. We can directly take that from the endowment table. So A due 40/20 payable 12 times will be A due 40/20 minus m minus 1 by 2m, that would be 11 by 24, in bracket 1 minus V raised to 20, 20p 40. So we'll calculate V raised to 20, 20p 40 separately. Again, I think we are talking about 4%. Yes, 4% ultimate mortality. So therefore, I would prefer taking D values. Then we want this A due 4% for ultimate mortality. 4020 13.927. So this 13.927 minus 11 by 24 into 1 minus answer bracket close 13.66577, and then ADU 60 minus 3 by 8, ADU 60 for 4%, ADU 60 will be here. It's 14.134. $13.759. Let's get this. So I'll have 12,400 into 0.430038 into answer. Then here 12 into 163.989p. Then both the p parts together. So see ADU 4020 we can directly look up in the table. ADU 4020, ADU age 40 and 20 is 13.927. 13.927 so I have 0.8 into 12 plus 0.04 into 12. So 13.927 minus 1, so I will have 12.927. So I have basically 15.80496 p. And without p, this value $60 into v raised to 20, 20p 40, 1430038 into ADU 60 payable 4 times. Okay. Now we can make the equation. I will have 0.24p will be equal to 163.989p minus benefit was 73369.471 minus the expenses, that is 15.805p plus actually minus 3.355.014. Let's rearrange to get all p's together. Okay, so we will have this much minus this much minus this much. So 163.989 minus 0.24 minus 15.805, 47.944 will be equal to 73369.471 plus 355.73724.755. So our P, that was our monthly premium, would be this much divided by 147.944. That becomes 498.33. But of course we wanted answer as annual premium. Annual premium will just be into 12. This becomes our annual premium. Okay. So as I said, the concept is very straightforward, but calculations are definitely long. Okay, and we make a lot of mistakes at the beginning. You will definitely make mistakes in making the equation, and later on you will be making mistakes in calculation as well. So the only way you can avoid both the mistakes is by practicing. Okay, there's no other alternative. Okay. Now in all of these questions that we have seen, our renewal expenses were paid annually. Renewal expenses were paid annually. Many times, especially when our premium is paid more than once a year, we will see that our renewal expenses may also be paid more than once a year. Okay. So if I say renewal expense paid m times a year. Okay, if renewal expense is paid m times a year, they will give you two situations. They will give you two situations. Okay. The first situation is going to be where we will be excluding one payment, excluding the first payment. Okay, excluding the first payment. And we might be excluding the entire first year, excluding first year. Now up till now, when the payment was annual, okay, our payment was annual, then first payment was basically our first complete year. So that is why we subtracted 1. But when we have payment m times a year, what happens is we can be excluding first payment, or we can exclude the complete year. In such cases, okay, so let's say 12 times a year expenses, I will have 12 expense, I will write it as E. Okay, 12E, that becomes the annual expense. And then we'll have A due payable 12 times XN. And And then what we'll do is minus, we will be subtracting one payment. So one payment becomes 1 by 12 because this is annual payment. 12E was the annual payment. One payment becomes 1 by 12 then, excluding one payment. Now if you are excluding the complete year, what we'll do is we'll say 12E A due X N payable 12 times minus, now we cannot just say minus 1 because we will have to consider what happens if a person dies within that 1 year as well. Okay, so we will be subtracting all the payments that were supposed to happen in the first year. All the payments that were supposed to happen in the first year. So later on we will see such questions where renewal expense will be paid more than once a year and we are excluding either one payment or if we are excluding a complete year. In that cases we'll have to do these two separate equations. Okay. This is all in the premium chapter. You don't have to worry too much about. There is a small thing where we have another way of calculating premium, that is using probabilities. I'll talk about that next time. Okay, but before we go to next time, we have something called as future loss random variable. Okay. Future loss random variable. It is just the random variable that we get for future loss. A future loss random variable, we'll write it as L. L is nothing but present value of loss. Okay, future loss random variable, we'll write it as L, and L is nothing but the present value of loss. Now at the beginning we have made what our present value of loss is going to be. So L, we said, was nothing but the present value of benefit plus bonuses plus present value of expenses minus present value of premium. So in different type of policies, we will be making these in different ways. So if I say whole life policy, in a whole life policy, we say that the benefit is paid whole life and premium is also paid whole life. That means the premium is paid till a person dies, and then if the person dies, the benefit is paid. Okay. So in such cases, how would we make our future loss random variable L? Okay, the benefit, present value of benefit for a whole life would just be, remember the present value, so S v raised to kx plus 1. This is what we say. Let's say this is payment at the end of the year and we will have immediately. If you are talking about immediately, present value of benefit will just be S v raised to tk, tx. Payable immediately on death. What about our expenses? Present value of expenses, initial expense will always be I. Renewal expense, let's assume we are talking about annual values. So we'll say E, A due, x minus 1 and then plus f v raised to kx plus 1. Immediately the only difference would be this. Okay, on immediately we will have f v raised to tx. Okay, my mistake here, we'll have a due present value, right? A due kx plus 1 minus 1. Okay, that is what the present value of annuity in advance is, life annuity, right? So only difference would be this going to this, because even if the benefit is paid immediately on death, our annuity will still be in advance. That is what our assumption is. The renewal expenses will be paid annually in advance. Okay. Present value of premium, so it is just annual premium P, and then we'll have a due kx plus 1 payable till a person dies. And immediately it will be exactly same, so I have not changed it. Okay. So accordingly you will make your L. In this we can have a few more complications. We may have premium payable m times a year. You can make equations accordingly. We may have expenses paid m times a year. You can make the equations accordingly. But very rarely we get such complications. These are the only complications that we get. So at the end of the year you can make your L. Immediately on death you can make your L. This is called as our future lifetime random variable. Okay, sorry, future loss random variable. Okay, future loss random variable. Okay. What about a term policy? In term policy, we say present value of benefit. Okay, I am again taking at the end of the year. Okay, immediately we can change a few things, so I will be writing in terms of at the end of the year only. So present value of benefit will just be s v raised to kx plus 1 only if kx, so let's say if kx was less than n. Okay, if kx was less than n, then this. Otherwise we have 0. If kx is greater or equal to 0, then we will be paying nothing. In a term assurance, what happens is our expenses will go accordingly. Present value of expenses, also we will have two cases. So in present value of expenses, if a person dies, okay, within n years, what happens? And if a person dies after n years, what happens? So if a person dies before n years, I was definitely paid, and the renewal expenses were a due kx plus 1 minus 1 and then plus f v raised to kx plus 1. This happens if kx is less than n. If kx was greater than n, that means the death occurred later than initial as it is, but in renewal expenses, all the renewal expenses of n years have already been paid. All the expenses of n years have renewal expenses have already been paid. So I'll say E a due n minus 1. All n years of expenses have been already paid, and there was no terminal expense because We are saying the person did not die, so no terminal expense. What about our present value of premium? Again, two cases, P into A due kx plus 1 if kx is less than n, and P into A due n, all n years of premium would be paid if kx is greater or equal to n. So therefore our loss function will be two different functions when kx is less than n and when kx is more than n. So I will have loss function was what? We had benefit plus expenses minus premium. So let's make that benefit s v raised to kx plus 1 plus I plus e a due kx plus 1 minus 1 plus f v raised to kx plus 1 minus p a due kx plus 1 if kx is less than n. Otherwise this was 0, so I plus e a due n minus 1 plus nothing else. I will have minus p a due n if kx is greater or equal to n. You can simplify it, you can add these two, okay, and make it simplified. So I will simplify it. I will say I have s plus f v raised to kx plus 1, then I minus e plus, we'll have, or I'll say minus p minus e a due kx plus 1 if kx is less than n, and again I will add these two. I have I minus e minus p minus e a due n if kx is greater or equal to n. Next time we will see, next Saturday, we are going to see how we will be using these. Okay, so make sure you revise everything that we have studied today. All of these present values are all from our chapter 16, chapter 17, chapter 16 and 17. So make sure you revise those as well. Okay, you will see each one of these just step by step came from those particular chapters only. Okay, so do study that. This is very important. We get directly question that make a future loss random variable for so and so policy. Okay, so let's end our class here and we will meet for our doubt lecture on Wednesday. Bye.
Thank you, sir.
Welcome.